Hello everyone. Last Friday, we talked about since the market has crashed, should we buy the dip? Many people viewed that video and got back to me said they want to see a bit more discussion on should we buy the bottom. It sounds like many people are really ready to jump into the market, especially in this week. There is a pretty big rally in the U.S. stock market. Back to back, the market was up 3 days, not today, but was up from Tuesday to Thursday. From that $2 trillion fiscal stimulus plan from the federal government and also the Congress, to the unlimited amount of monetary policy stimulus from the Federal Reserve, to the growing rate slowing down in some of the European countries for the confirmed case. Of course, all of that very positive factor has been encouraging many of the investors to jump into the market. And since many people have this on the top of their minds, let me try to discuss about buy the dip from another perspective today. So we're going to cite another article today, and the title for the article is "Should You Buy Stocks When There Is Blood on the Street?" Let's get back to where this quote comes from. Blood in the street is coming from Baron Rothschild. When Baron Rothschild take the huge panic after Napoleon's Waterloo battle and make huge ton of money, he said this quote, "The time to buy is when there's blood in the street." It's certainly a very memorable quote, but it's really hard to implement because many people don't know there is a second half for the sentence, and that is even if it is your own. So the complete sentence is, when there's blood in the street, it's time to buy, even if it is your own blood. So a lot of us, we are really afraid of or even scared of pain or blood. So when you are seeing vividly yourself is flowing around in the street is your own blood, are you still, do you still dare of buying the dip? Are you still capable of buying the dip? Have you get ready for the next round of massacre and not bleeding to death? When you are thinking about taking advantage of this bottom of the market, are you ready for preventing others take advantage of you? The thing is, buy low and sell high is everyone's nature, right? We all want that. But be greedy when others are fearful is often against human nature. That greedy, when others are fearful, is often losing all of the hope. And that's the last little hope at that moment. It's the last little light in the darkest night. Now, currently, when there are so many people who has money and ready to jump into the market smells hope. So it's likely that, it's possible that the market just start to bleed. Oftentimes is when everyone, most people who want to buy the dip, they are either trapped or they lost their hope. That's the time the bottom will appear on the horizon. Investment is a game of probability. Unless you have insider information or you can make the market, no one can have 100% accuracy to forecast the future. Whoever can say they have 100% sure that the market is bottomed or the market is already peaked, I think they are the voodoo in the stock market. We do from time to time hear someone can escape the market at the very peak, or someone all in when the market is bottomed. But for someone who can consistently time the market, you probably hear that, but you never see that. Not only me, who are not very experienced in the stock market, but also for Warren Buffett. Warren Buffett said very famously, "I have never known anyone who could consistently time the market. And in fact, I have never known anyone who was able to consistently time the market." So here, we are neither encouraging you or discouraging you to buy the dip. We simply want to lay out all of those kind of risks, so you know what you are facing before you jump into the market. Just don't like one of my friends. He's going to the mountain for a extreme rafting. And of course, it was pretty dangerous. The raft was turned over by the water. And after he was barely survived that, he just learned the day before he went, there are a few couple people drowned in that same location. So it's really hard to say if the market has bottomed, but we just see the peak of the last bull market. So let's use that as an analogy. It's as challenging as how to escape the peak as how to find the bottom. Because a lot of people who are very knowledgeable, very insightful, knows everything about the market, they have already seen the crisis coming. But even for those very smart people, they can still not time the market. For example, in 2018, the top hedge fund firm is Crescat Capital. Their global market hedge fund was one of the best performed hedge fund of the year. They got 41% return when the S&P 500 dropped by 6%. So they beat the market by 47%. Very, very, very impressive. And this Crescat Capital, they go out in the beginning of 2019. They essentially shouted to everyone saying that this is the century strategy, that is short the global stock and buy gold. And of course, everyone can know the result. They are not wrong, but they are a little bit early. And in the stock market, if you are a little bit early, then you are wrong. So in 2019, when the US S&P 500 was up 28% without taking into the dividend payment, Crescat Capital, they lose 22%. So they were beaten by the market by 50%. They're not only kind of turn over everything they gained in the previous year, and they also feel huge pressure for redemption. A few days ago, this Crescat Capital, they published a investor letter. The title for that letter is Blood in the Street. They certainly know about that. So after the big defeat in 2019, they still keep bleeding in January and February of 2020, and they lose 11%. And finally, they waited. They finally found out that market crash. And in March, they got the 31% of return. The other example is Warren Buffett. Warren Buffett already see this market is overvalued, and he has stocked $1,000 billions of dollars cash. But still, in 2018, he was too early, so his Berkshire Hathaway only got 11% of gain, very, very behind the S&P 500 big market. And of course now, Warren Buffett found this market crash, but I think he's still waiting for the right moment to jump in. So after we talk about the challenge of escape the peak, now let's come back to talk about buy the dip. Previously, we talked about using the 30-year VIX to fear index to identify when the market is fearful. And we talked about the short-term, mid-term, long-term return using that. If you are not familiar, I suggest you go back to view that video. We have a detailed discussion on that. Today, I want to discuss about how to quantify this very pictorial, the market has blood, blood in the street. Often we say if you have a 5% up and lower than 10% of drop, we call that the market pullback. Bigger than 10%, lower than 20%, we call that correction. So beyond 20% loss, then the market entered into bear market. Recently, the US market dropped from the all-time high of February 19 by about 30%. So let's say 30% or beyond can be considered as blood in the street. From 1920 to 2020, before 2020, that 100 year, there are only 6 times for S&P 500 start to drop below 30%. And one of that is barely 30%. So it's very rare for us to see blood in the street. And we are lucky to witness the history. The history is made almost every day. So in that 6 times, there's blood in the street, more than 30% drop. 4 of the times the market dropped by 40% or more. Three times the market dropped by 50% or even more. So it means if you jump into the market when the market lose 30%, you get a 30% off discount on your stock. However, 2/3 of the time, you may face additional 14% of drop. And 50% of time, you may face another 28% or beyond lose of the stock value. If we take the 5 most famous stock crashes in history, 1929, 74, 87, 2000, and 2008, we can see that in 1929, the Great Depression, and 2000, the internet bubble, it takes 3 years for the market to bottom up. If you buy the dip 1 year after 1929, the Great Depression, it will take you another 2 years to stay in a keep constantly declining market. And the second year will be even more challenging for you because the market dropped another 64%. In comparison, the US dollar market dropped about 57% in 2008 financial crisis. It dropped about 49% in the 2000 internet bubble crisis, and then rebounded. So since 1929, S&P 500 experienced totally 14 bear market, not including the current one. And the bear market on average takes about 19 months, and on average it will drop by 39%. The most deepest one is from September 29 to June 32, it dropped by 86%. The longest one is from March 37 to April 42, it dropped by 6%. So the biggest challenge for buy the dip is we never know where is the bottom. We never know if the market will rebound from here or will keep losing money, and you don't want to donate blood when there's already a lot of blood in the street. Many people are taking hope for the huge amount of fiscal and monetary stimulus plan. Cornerstone Macro, they analyzed during 2001 and 2008 what the market react to those fiscal and monetary policy, and found S&P 500 actually keep losing for a year. Personally, I kind of agree with Goldman Sachs chief equity strategist David Costin, his analysis. Essentially, we can consider the market has 2 scenarios. It can either have a very quick rebound, or it can take very long time. And this quick rebound or quick recovery versus the long recovery depends on 3 factors. Number 1 is how fast this coronavirus will be contained and the death toll of that. Number 2, the real economy, if they have enough cash and liquidity to go through this frozen period. And number 3, if the fiscal stimulus plan can stabilize the market's expectation for the future growth. Now we are seeing that most recently, the new unemployment benefit is 3.28 million people, almost 12 times higher than the previous high in 1982. And this past week, was the worst data since 1967, the first time we have this type of data. And many companies, even though they are not cutting their jobs, they are cutting their salaries from the up to the bottom. So if stopping this economy will cause a lot of corporate or small business to default, or they close up, or permanently losing their employees, then the damage to the real economy will be there, will be very long lasting for many times. We are going to use Mark Caton's sentence to kind of close up today's discussion. In his recent interview, he said things will get worse before they get better, and the markets will continue to reflect that reality. This means that a bottoming process will take more time and probably inflict more damages to the equities. And that is, as you heard that, it's possible, it's not necessary, but it's possible that the market will become worse before it becomes better. We have to see how this real economy and all of the following economic indicator, what they are directing us and provide the guidance for the future. In the last, no matter how bad is the market, no matter how bad is the market crash, eventually we believe that the market will rise up. There's going to be a rally coming back. It's kind of like the light split the darkness and give us a little hope in this totally desperation. So don't lose your heart. If you kind of feel bad or during this financial market, don't feel bad. Eventually it will come back. We are sure for that, but we just don't know how long it will take. So this market and what we discussed today is not for those seasoned, experienced traders. It's more for regular retail traders, retail investors. If you don't think you are brave enough, you are not lucky enough, you got to be very cautious before you go try to buy the dip. But for those people who are very skillful, who knows in and out about the market, who think they can really time the market and get big in this, go ahead for that. That's all for today. I'll talk to you next time. Stay safe and healthy.